Hello everybody and welcome to the Middle Class Investor. This is Seth Martin, your host. Today is September 27th and I'm recording on Saturday evening about 9:30, and I want to thank everybody for coming in to the YouTube channel and supporting the show, and I appreciate the comments, and it's all you guys have had some really good comments out there, and I just really appreciate it. Of course, you can forward the link to your friends, family members. You can follow me on Twitter at Middle Class Investor. Actually, it's at Investor Class, but if you search on Middle Class Investor, you can also find it. Well, we had an interesting week in the market. Just real quick, let me put the 5-year chart up and just say this is the Dow. Let me switch to the S&P 500 real quick. We've been looking at this rising wedge. We've talked about it ad nauseum, so I don't want to go into it tonight, waste a bunch of time doing that. I will do it from time to time just to recap, but and then this is the Dow. This is that trend line between the 2000 high and the 2007 high extended into the future. It was a pretty interesting week on the market. Let's go back to the S&P 500 and then zoom in a little bit. Let's look at about the last 6 months. And what we had was some pretty volatile action in the market. So let's see. These are daily. So this was Friday, Thursday, Wednesday, Tuesday, Monday. So this was last Friday right here when we touched this resistance box that we had placed on the chart, and I had talked about how it extended above this wedge and touched this resistance line, and that we should be looking for a pullback. And boy, did we get a good pullback. I mean, that was a solid pullback. This is a higher low, so we've talked about this at length as well. This is the low. The important previous low is down here, and obviously this is the high. So this is the definition of an uptrend. The probabilities say that the market will make then a higher high. Now, the problem with this, for me, and I'm only speaking for me, is that in order for it to make a higher high, it's got to be above that wedge line again. And I think my feeling is the probabilities of that happening are maybe still higher than 50-50, but are diminishing rapidly. And these pullbacks in here, but this day especially, these are pretty significant days. And I think the best way to approach this, let me tell you how I'm approaching it, and then mainly because there's not a lot of room in this bearish wedge. So this is what was interesting on Friday is, okay, so Thursday we had this big down day. That's this black candle right here. And then Friday we gapped up ever so slightly. This candle is actually inside the body of this candle, and this is called an inside day when the entire price action from a day is inside the body of of the previous candle. That's called an inside day. And what's typically happens is if you get a close above this high. So if Monday the market closes up here, let's say you get a candle that looks something like, this. Whoops. Well, yeah, it looks like this, and maybe it's got a little tail on it like that, and maybe a little tail on it like that. So this would be the close right here, let's say. So we're saying this top bar is the close. If we get a close above this high, then that increases the odds dramatically that the market makes a new high. Okay? Now, having said that, this could all just be a retrace. This day right here could just simply be a retrace of this large candle. So one of the things in technical analysis, and so we'll go into technical analysis again sometime, but one of the things you can do in technical analysis is you can take, and this is just a visual thing, right? But you can take the midpoint of a large candle, and this I think you could argue is a large candle, and if the market is below this and it's coming up, this tends to be resistance. If the market is above this and coming down, it tends to be support. So again, these are just guidelines, but what I would say is if you get a candle, if you get a market that looks like, let's say we get a, well, we can't have that because that's not what I said, but let's say you get the body of the candle is like this, and then there's a tail. In other words, we went higher than this high, but then the market turned around and sold off and went down. I think this is probably the first sign that we're gonna see something like a breakdown of this pattern, this rising wedge pattern that we've been looking at. And this will be, and I think we'll probably make a lower low. So in other words, here's our low. We'll make a lower low either into this resistance box or maybe one slightly lower, and then what we'll be looking for at that point is some sort of correction back into the underside, underneath this trend line before the next move down. So these are the different scenarios. I know that's pretty technical, and there's no way to know really which one's going to happen. I think what you do is you talk about both scenarios and you prepare. What am I going to do if it closes above here? What am I going to do if it closes below here? Maybe the answer here is nothing. Maybe I don't do anything here, and I wait for this to happen just to confirm that I actually want to go to cash or something in my 401k. And then I wait. Once I decide I'm going to do that, I wait for the correction, and I go to cash. Something like that. Those are some scenarios. But the trend is still up. So having said all that, the trend is still up, and the high probability at this point is that the market will make a higher high. But I want to caution you there because you can see that this trend line is pretty solid difficulty for the market for a while now. So that's one thing I'm looking at. The other thing I'm looking at is there's just not a lot of room here. I mean, from this high, this 2020 down to 1960, you're talking about 60 points. Yeah, that's quite a bit on the S&P. But I mean, I would say before it went higher, you're going to at least see it come down and touch this lower trend line and go back up so that traders can get the full bang of this move. Because if it just goes up from here, there's hardly any money here for them to make. So anyway, that's kind of what I see for right now. Excuse me. And that's in the S&P 500. Whoops. Sorry about that. Close that down. Now I want to look at the Dow because the Dow, there's something interesting also going on in the Dow. Let me put a little bit more time up here. We've talked about this trend line in the Dow. This red line right here, this is connecting the 2000 and the 2007 highs, and then I've just extended it into the future. And you can see the market got up above it and then has quickly recoils from this area. So this is also an area that's showing some difficulty in the market. Now, it's hard to see here, but you can kind of see a pattern here where this goes up, down, and you can see a really long kind of drawn out deal here, and then another down, and then an up. This pattern is usually occurs. It has a name. It's a diagonal pattern. Some people call it ending diagonal, but this pattern occurs at the end of trends and is usually terminal. In other words, it signals the end of a trend, a major trend. It never comes in the middle of the trend. It always comes at the end of the trend. Now, the end of what trend? There's the question. So, if you're looking at a 5-year chart, it could just be the end of this trend, from here to here, or this trend from here. More likely this one from here to here. But if it's the end of this trend, that means that we're going to roll over probably and at least come down to this 10-2 area or so. Now, the thing about a diagonal, an ending type diagonal, is it's kind of like that rising wedge. You go back to the start. Let me put the start up here. The start of the diagonal, in this particular case, is right here. Okay, so the thing about an ending diagonal, it usually retraces 100%, and it does it pretty quickly. So we're talking about the Dow going back to about 14,600. So let me zoom in on that so you can see that. So here's the start of the diagonal. You can see the move here. And if it breaks down out of this, which it could, or it might not, but if it does, you're going to see the Dow move fairly quickly down below 15,000. So that's a pretty good move. Let's see what that is. Let's measure that just for our entertainment value. That is 15%. So maybe that's the correction that people have been talking about. We'll just have to see. And maybe that's okay for you to go through that. I'm not sure, but what I'll do is when we get to a point where you could make a decision, we'll definitely point that out here in the program so you can look at it. Okay, some other markets of interest. Let me go back to a 5-year. Is the Euro US dollar. That continues to be weak. It's come right down into our box that we've drawn. It's hard to say at this point whether that's going to hold. My gut feeling is that'll probably hold because this is a pretty good move. So we'll probably get a bounce up, but then this trend will probably resume. And I don't know. I mean, you probably don't want to be holding euros. Is about the best I can say about this pattern. We've got a high, we've got a low, we've got a lower high, and here's a higher low, but now we got a lower high again. So we're at least making there's at least some sort of downtrend here. It could be some sort of continuation pattern or something, but it's at least a downtrend for now, and price seems to be narrowing. Although it could be done, it could just be about done narrowing, because if we kind of draw a line this way, like that, then maybe the euro comes up and bottoms out down here at what would this be? About 123. So maybe you could see the euro go to 123 and then bounce up and then go higher. But for right now, the euro, I mean, there's nothing but sellers in the euro. So let's look at the 10-year bond market interest rate. The interesting thing here, we've been talking about this low, whether or not this is the low in the interest rate market, and what the significance of that could be. If I go back further, and I've talked about this before, but if you take a trend line down here, you notice that since really going back to 07, this trend line has been intact until here. So what's significant about that is that this could be the first move off the bottom. And if it's the first move off the bottom, then this would be the first correction into the first move off the bottom. And usually that next move, that third move, is significant. So the 10-year yield could pull back a little further, or it could be over. It's hard to say right now. My gut feeling is that the market sells off, some money is going to flow into this 10-year, which could take us down to, just below 2% yield on the 10-year. So, the bigger thing about the 10-year is we are much closer to the bottom than we are to the top. And the reason that's significant is if you own bond funds. So there's just not much. If you own a bond fund, there's just not much more money to make from the 3% yield area down to 1 or 0. But there's a whole lot more money to make going this way to 5% yield, 8, 9, 10, so on and so forth. And really what you need to ask yourself is, what is the likelihood that the U.S. government can continue to borrow money after we've already borrowed $18 trillion? And if your answer is that's not very likely, then that usually means interest rates are going to be going up. So if you own bond funds in a rising interest rate environment, you're going to lose money. So that's why we've been calling attention to this and continue to do so. Let's look at the VIX real quick. Let me pull in let me look at just a 5-year VIX. So the VIX, we've talked about this, you'll hear it on the news, called the Fear Index. And we drew this little trend line in here. Let me zoom in a little bit. So we drew this little trend line here, and you can see that for the most part has been holding. And when we had those sell-offs last week, the VIX popped all the way up here, and then pulled back in on Friday's rally. So if we get a breakout of that wedge, you could see the VIX, you could see it spike into this 20 area, 20, 21 area. Now, if you're selling options in the market or something like that, that's going to be great for you. The VIX is there to, it's the price of index options on the S&P 500 is what it is. So the higher the price to buy options on index options on the S&P 500, the higher the VIX goes. That's basically what it is. We don't need to get into all that. It's just a good way to tell how much. If you've got billions of dollars under management, you can't just sell and go to cash. So what they do is they buy out of the money put options on the S&P 500 index. And the theory is that let's say I've got $1 billion under management. Well, a contract on the index for the S&P 500 is about $75,000. So you can take, let's say you want to put a 20% hedge on. You take 20% of $1 billion, which is $200 million. You divide that by 75,000, and that tells you how many contracts you can buy on the VIX. On the S&P 500 index to hedge your portfolio. And that's just because the reason they do that is because they cannot move that amount of money from all those long positions to cash. For one thing, they're required by law to stay invested, these big money management guys. And the second thing is it would crash the market if they did that. So they just don't do that. The index options are very, very liquid. They can buy those, and that's what causes the VIX to move. So you can see that, over the last several years, going back to really hasn't been a lot of fear in the market until you get back into mid-2011, back in here. And so, the VIX has done nothing but go down. And there's a saying, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. That's how you can remember what to do around the VIX. That's really all I have this week for the middle class investor. We spent quite a bit of time on that S&P 500. I don't know if you guys have got charting tools out there. There's a there's maybe what I'll do is I'll research that for next time and take you to a couple of websites where you can look at charts. I think you can go to like Yahoo Finance or Google Finance, but the charts aren't very good. You're not going to be able to draw or annotate on them, and you might want to have a chart with a picture or something laying around just to kind of let you know where you're at. But again, if we close above that Friday's high, that inside day high, then you look for you close above this high on Monday. I think you look for the market to go higher, even though there's not a lot of room for it to go higher. You could still get up into this 2030, 2035 area pretty easily, I think. But if we close below this, look for the wedge to break, and then it's decision time. So you guys be thinking about that. If the wedge breaks, what are you going to do? Do you do anything? Maybe you do nothing, and you go ahead and just wait for confirmation. The confirmation would come with a massive, sell-off and a lot of fear in the market and whatnot, and then you would wait for the retrace back up, and maybe, you might be able to get, with a retrace, you might be able to get out around, somewhere at the bottom part of this wedge, wherever that is at the time. Maybe not. It just depends. Then you might be holding, to get back to that point, you might be holding until the whole thing's over. So, the thing about the market, let me say this about the market, because people tell me from time to time, they say, "Oh, that can't happen again. That was a once in a 100-year event," or something along those lines. One of the things you need to think about in the market is the market can really do anything. Anything is possible. And I guarantee you, right here on this, in this month, what month is this? In October of 2007, right here, if you'd have said, hey, the market's going to crash and it's going to go down, let's see how much it went down. The market's going to go down 58%. 99.9% of the people that invest money would have said, no way. It's impossible. and yet it did. Okay, so you just need to think about that. Look, let me show you something else while we're talking about history. This right here is the 1929 crash. Let me zoom in on this a little bit. So this was the stock market crash. Okay, this was the day where that you always see on the news. Okay, and it went down, and it started to go back up, and people were like, "Oh, thank God the psychology took over, right? Thank God we survived that, right?" And what you had here is you had a, what is that? 44% crash right there. 44%. Is that right? Yeah, 44% in 62 days. That's a huge sell-off. Well, then they got a rally, okay, of 43%. So they retraced about 50%, okay, of what they lost. And they said to themselves, "Oh wow, thank goodness we survived that. We just got out of that barely, right?" And in the interest, this is one of the things Fibonacci is good to use for. If you let me do this first. Let me change this to at least weekly. Sorry about that, because these months are the month bars are kind of hard to look at. So let's look at the weekly here. Oh, we were going to do Fibonacci. So let me make a little Fibonacci retracement here. Come down from the high to the low. And what you'll see is it went up between 50 and 62%. And what you'll see on the first, when you have a first move down, you'll see this 62% retracement pretty often. That's why I'm not necessarily looking for the 10-year Treasury to be done pulling back yet, because usually you get about a 60, at least a 50% retracement, and we've only had about a 35% retracement. But here, everybody started feeling good. But at the end of the day, look what happened in the S&P 500 over the next, 3 years. The market lost. I'm trying to see which one of these is the low candle. I'm not sure. It's showing 86% of its value. 86%. Now, I guarantee you nobody saw that coming. People never see it coming. That's the point. It comes, or they never see it coming, and yet it comes anyway. So and the problem is you don't know. Let's zoom in on this right here. So let's say that you just went through this. Okay, from here to here. That's only a 10% retracement. So that's analogous to, that's the correction we've been looking for. Okay, does that sound familiar? Does that sound familiar when you turn on the TV and they say, I'm looking for a 10% correction here? And that's fine, we got a 10% correction, but then look what happened. Retrace between 50 and 60%, and then over the next, now it went to here, right? So I keep zooming in and out of this, but what I was looking at is this first move here, but then you didn't take action, you didn't recognize that bounce up as corrective, and then you lost another 40% or 46, whatever that was when we measured it a second ago. So just you need to have, you don't need to have anything, actually. I'm saying you need to have, I'm just saying don't get suckered into the rhetoric that says, that can't happen. I mean, the technology today, the number of investors in the market, there's a whole list of reasons why people say that can't happen again. And I'm just telling you, it can happen again. And it likely will happen again. So, point is, the bigger point in all that is not to scare you or to make you fearful. It's to kind of jolt you into thinking, okay, I need a plan here. I'm gonna have to think about this and actually think about what I'm gonna do if this happens, or if this happens, what am I gonna do? That's what this is all about. This is why I'm doing these videos, so that you don't at some point feel uncomfortable and go, I don't know what to do now, except just sit here like a deer in the headlights and get run over. And we've talked about this analogy before, but it's basically what we're trying to avoid is that train barreling down the track and it's just going to run us over. We don't want to be run over, so let's just step off the track. That's all we're going to consider doing. And you can always get back in. The market is going to be there. Okay, it's not going to go away if you step off. Now, getting back in sometimes is hard because it has its own set of issues in psychology. But there are ways to do it in a safe, systematic way that that'll keep you from losing a lot of money and get you back engaged with the trends. But it's basically trend. We're looking at trend. So Middle Class Investor on YouTube, on Twitter at Investor Class, and you guys, especially if we start breaking out of this rising wedge, make sure you send a link to your family and your friends. Don't let them lose a lot of money. They're going to be mad at you if they know that you know something and didn't share it with them. Okay? So don't let your friends lose a lot of money. Don't let your family members lose a lot of money. Don't let them lose sleep at night and worry and all these horrible things that go with, your $1 million account got cut in half to 500,000 or whatever. So that's it for this week, you guys. I'm expecting one way or the other. We're either going to make a new high. I don't think it'll definitely happen within the week if we make a new high. And if we break out of the wedge, it'll definitely happen within the week. So one way or the other, we're going to be talking about either a new high or we're going to be talking about how we broke out of this wedge. So I hope you guys are looking forward to that. I know I am. And because we've been talking about this rising wedge for a while, and kind of looking forward to talking about something else. Anyway, that's it for this week, guys. Thanks for coming in and viewing The Middle Class Investor. Until next week, take care. Bye-bye, everybody.